Hey, what's up everybody? It's your mortgage expert, Brian McCauley. So you're looking to buy a house in Dallas, Texas, and you're wondering what's going on with this new Biden Fannie Mae Freddie Mac rule where people with higher credit scores actually get worse interest rates? Well, it's kind of true. Stick around. In this video, I'm going to tell you all the details you need to know. Okay, so listen, the DFW housing market is heating up and there's a lot of activity out there and there's a lot of buyers entering the market. We're seeing a lot more demand, a lot more multiple offers. But one of the things people have been waiting on are interest rates. Interest rates are trending down, they're trending in the right direction, which is great for our buyers out there. But there's this weird new rule and a law that came out from the Biden administration for conventional loans. There's a lot of confusion around this, but the headlines have been people with higher credit scores are now going to get worse interest rates than they did before. Well, that's partially true. So I want to go back in time and kind of tell you how it worked before and then how everything's going to work now. So on conventional loans, mortgage institutions use what's called a matrix. A matrix is just a fancy chart that says, based on all these different variables, this is what the person qualifies for and this is the interest rate that a person gets. There's a lot of things that go into that equation: down payment, occupancy type, property type, all these things, right? But one of the big variables that affect the interest rate is the credit score. So in the old school model, the higher the credit score, the better the interest rate. The lower the credit score, the worse the interest rate. So on the new model, that still is applicable. The higher the credit score, the better the interest rate. The lower the credit score, the worse the interest rate. It's just with this new guideline and new rule in place, what they've done is basically they've stopped rewarding the people at the top between the 720 and the 740 FICO score, doing 10 to 20% down, where they used to get the most competitive rates. Now their interest rate is actually a little bit higher. The other big adjustment that has been made on this is on conventional loans, 680 used to be the threshold on a credit score, to where as you got all the way down from 680 to 620, which is the lowest FICO score that you can qualify for on a conventional loan, they used to make really big what's called risk-based adjustments, or known as LLPAs, loan level price adjustments. So when you see that stuff in the headlines and it's talking about LLPAs and things like that, that's what they're referring to. So on this new matrix and this new rule, what has happened is, the part that I do like is anyone below a 680 FICO score and all the way down to a 620 is not going to get punished as much as they used to. I like that because sometimes the difference of a 740 FICO score borrower with 10% down and a 640 FICO score with 10% down could be anywhere from 2 to 3% on the interest rate. That's a lot difference, and that's also a big deal with the payment. So now basically what has happened is they've shrinking down the gap. So now in theory of it being 2 to 3%, it may only be 1.5%. So right now, hypothetically, if your 740 person got a 6% rate and your 640 person got an 8% rate, now that 740 person might get 5.25, which is a little bit higher, and the person with the 640 might get 6.25. So here's where the challenge lies. I like the affordability. I like the fact that the people that are under 680 aren't penalized as much. This gives them more incentives to go out and shop, gives them cheaper money, makes their payment cheaper, and obviously makes the home a lot more affordable. That should encourage and incentivize a lot of these people that are sub 680 to go out and buy homes, because now the affordability is better for them. What I don't like about it is the people at the top who have behaved correctly, paid all their bills on time, have a good amount of money for down payment, are not getting rewarded as much. In fact, in a certain part of the matrix between 720 and 740, putting 10% down versus 20% down, these are actually the people that are not being rewarded as much and actually punished where they wouldn't have been otherwise in the past. So it's actually funny to see the graphic, and obviously I'll share this guys with you in this video. What happens is, right now, if you're a 720 to 740 and you normally wanted to put 10 to 20% down, your interest rate's going to be worse than if you actually put 5 or 10% down. Yes, That is correct. If you put less money down, you will get a better interest rate. It's counterintuitive to a human being because they think, oh, well, the more money I put into the transaction, the lower my risk is. The lower my risk is, the more the bank will like me. The more the bank or mortgage company likes me, the better deal that they're gonna give me. So logically, that is accurate. The idea behind this rule is they're trying to give breaks to the people that are at the bottom that aren't quite as strong and not penalize them as much, and therefore there's more affordability and it can help them get into homes. What has happened in this scenario is the people at the top are now not going to be rewarded as much. And now they're having to pay a little bit more, and that's where the premiums are coming from in order to offset and afford and help out those at the bottom. Now, a third change to this matrix that they didn't have before, on conventional loans, 740 used to be the highest credit score that you could get graded at, meaning 740 and above was considered an A+. So if you had a 741, a 742, or an 850, you never got any bonus on the interest rate. It's just that's the highest tier from a FICO perspective that you could get. One of the things they've done to this chart is they've added on 740 to 760, 760 to 780, and 780 and above. So now if you're really good with your behavior, and you do an excellent job with your credit and you're at a 760 or 780, you're starting to get rewarded even more because your FICO score is at the top, and therefore you get a more competitive rate. So the challenge becomes, with an imperfect system, how do they go about making it more affordable for the folks at the bottom? Well, they are not going to penalize them as much on the interest rate. That's going to help them get a cheaper rate and a cheaper payment, and hopefully boost them off the sidelines to go buy a home where they wouldn't have otherwise. The downside to this is the people at the top that end up fitting in that certain box where the government is taking the premiums from are not being rewarded like they should. So they're having to take that money, give it to the folks at the bottom, for lack of a better analogy, but those folks are being penalized at the top. So the tricky part is the why. Well, the why all depends upon the people in the administration and the position that they're taking to try to make housing more affordable. The challenge is, obviously, if you're not rewarding those at the top with good behavior and you're giving it to the people at the bottom, it becomes a struggle, and the people that have done everything the right way all the time don't feel like that they should be penalized and feel like they should be rewarded the most for doing what they're supposed to be doing. And now they're incentivized to put less money down to get a better interest rate. But in the meantime, if you put less money down, it's going to make your mortgage payment higher. Now, there are alternatives I've been working with my clients on when you're in that 720 to 740 mark and you're wanting to do 10 to 20% down. And we've got some ways to work through how to make sure you don't fall into that box and get penalized with that higher interest rate. If we get a specific planning session, we'll discuss why. So we will see how this thing unfolds. Again, I think in theory it's good. I do agree with the part that some of the folks at the bottom with imperfect credit are being penalized as much, and the rates will be better, the payments will be better, but we will see if this is enough stimulation for them to get off the sideline. The other challenge is sometimes is if they are, not rewarding the folks at the top as much, and they're taking the extra premiums and supposed to be given to the folks at the bottom with the lower FICO scores. But let's say all of those people during this housing surge cannot actually get a contract on a house because they're getting outbid, multiple offers, things become challenging again as the market picks up. What happens to all that money and that extra premium that's being collected on the rate? If it doesn't go directly to the people who are supposed to benefit because they're not able to get houses, what happens with all that money? So it's an interesting change. It's an interesting time. I like part of it. I don't love the other part, but overall, I think it will help more people than it will hurt more people. We will just see what the indirect and direct impact is on those that are not being rewarded as much and those are not being punished as much. So listen, I hope you guys found this video useful. If you did, do me a favor, like, comment, subscribe, even share it with somebody you know that could benefit from this information. If you want to have a conversation with me just around the future of housing, your financial situation, or even talk about it pre-approval, give us a call, shoot us an email, send us a text. We're always here to help. Until next time, stay tuned.